Welcome to another video presented to you by Crunch Times, the place to be to make the tangible connection between your business operation and its financial performance. As many as 72% of online shoppers will go to a competitor if the product they want is out of stock on your website. And as many as 67% of those online shoppers keep shopping from your competition. And that's why we put this video together to talk about inventory management and how you can take control of your inventory. This video is full of practical knowledge, so please actively watch, take notes, and get yourself a calculator because we are going through a lot of numbers which are fun and exciting, and you're gonna learn a lot. If you have watched one of the videos that are on our channel, we extensively talk about thriving businesses and what are the characteristics that they have in common. One of those characteristics is inventory management, and that beautifully ties into your cash management and cost reduction efforts that you are going to have for your business. So, of course, we are talking about inventory management today. But why should we care about inventory management anyways? I'm sure you're familiar with all these challenges that you have had in your business or you are going to have if you have just started. So you're ordering too much, you are running out of stock, and maybe you have a lot of back orders that you are dealing with. And another challenge that the business owners have is sometimes there is just no data to analyze. I know many of the online shopping platforms, especially Shopify, gives you many reports to analyze, see trends, look at customers' behavior, and possibly forecast demand. But wouldn't it be nice for you to actually own those information, understand the concepts, so you will be able to play around with it and to fully utilize the platforms? So that's why we are here. You might think to yourself, I'm using a system, a software, or I have a lot of automations. But as I mentioned before, as a business owner, you really need to understand the logic and the reasons behind all those numbers and be able to actually own it and play around with it and analyze it. When it comes to inventory management, there are some golden rules that we should follow. So first one is we should have the right inventory. By the right inventory, I mean if you are selling books, you are not stocking on bouquet of flowers. You could as promotional items, but it's not your main business. You know what I'm talking about. The next golden rule is having those at the right quantity, in the right place, at the right time, and at the right cost. So in the right place, we mean you need to make sure that you store them properly so they don't go obsolete. At the right time, we mean if you're selling Christmas stuff, you are not buying them in January and selling them in Christmas, so you get the timing right. And at the right cost, we mean you need to really negotiate, understand how much you are paying for the inventory, get down to your numbers, and understand the costs as well. In this video, we are going to fully focus on the second golden rule, which is getting the quantity right. We have some concepts to unpack here, and the first one is inventory movement. A stock movement shows the movement in and out of a stock due to sell to a customer, transfer of inventory, sales, or sometimes returning the stocks. I really want to encourage you to follow along, calculate, really use the examples to understand each concept. This is a candle selling business. They crafted 15 more candles. They sold 40. One has gone obsolete, and we want to know what was the closing inventory. So I gave you the formula. Go ahead and cheat. Closing inventory is your beginning of inventory plus all the purchases, or in this case, crafts, minus your sold items and minus obsolete items. Following that formula, you are going to end up with having 4 candles as your closing inventory. And if the unit cost is $10, your beginning of inventory worth $300 and the closing $40. Your inventory movement is your $300 minus the $40. This business also sells soaps and essential oils. And if you look at their soaps and essential oils, you will see that inventory movement has gone from $300 at the beginning of the month to $625 at the end. And for essential oils, they started with $30 and they sold everything. So why is it important for you to understand your inventory movement? Because that translates to what are the items that are sitting on the shelf and are not moving quickly. So then that can draw your attention to the items that are slow moving. Or you can focus on your purchases. Did you need to buy that many soaps for the months? Maybe you didn't, because your sales forecast could be only 5 and you could utilize that investment somewhere else. The next concept that we are going to unpack here is cost of goods sold. As the name indicates, cost of goods sold, or COGS, is direct costs of producing the goods sold by your business. This amount indicates the cost of the materials, labor that has been used to directly create those goods or products. If you look at this colorful formula I have here for you, cost of goods sold formula is beginning of inventory plus purchases minus end inventory. If we go back to the candle selling business, they started with $300. They crafted 150. If you remember, the unit cost was $10. And then the closing inventory is 40. So you go ahead and cheat again, because I have the formula down below. So their cost of goods sold is gonna be sitting at $410. Again, why do we need to care about cost of goods sold? If you look at this pie as your total sales, cost of goods sold is a big portion of that pie, and what is left is your gross margin. You have heard the term multiple times. If you watch Shark Tank, I'm sure you have heard it every minute. What's your gross margin percentage? That's the question they ask. And the reason is because the gross margin is the dollar amount that is left in your pocket that's going to take care of the rest of your operating expenses, such as your payroll, advertising, rent, computer, and so on. So that's really important to understand the cost of goods sold, so for you to be able to control your gross margin. And that shows how you can afford the rest of the expenses you might have. I have played around with the numbers in the candles business and just moved some of the inventory and purchases around. And you can see with having more purchases, your gross margin is impacted very significantly. So you can see the gross margin from $205 down to $40. To recap on the cost of goods sold, it's really important for you to understand that number to be able to see what your gross margin is and what that percentage compared to your sales looks like. I mentioned the inventory turnover when I was talking about your inventory movement, but the definition reads as the ratio of how many times a business sells and replaces inventory over a set period of time. Inventory turnover is really important because it shows the health of your business. The higher the ratio, you have a more successful inventory management and of course a healthier business, because you don't want to keep your items on the shelves and let it be covered with dust. Inventory turnover is calculated by following this formula: your cost of goods sold divided by your average inventory. If we want to go back to the candles business and utilize those numbers from different slides, we will get to an inventory turnover ratio of 2.4. We need to understand what the time period of this analysis is. If the time period is only 1 month, it means they were able to turn around their inventory 2.4 times in a month, which is a very good number to have. But if it was for a year, 2.4 is really low. It means the items were just sitting on the shelf, collecting dust, and they were not able to turn them around properly. For us to be able to take control of our inventory management, we also need to understand the next two concepts very well. The first one is your reorder point. It means the point that you actually need to reorder inventory. And the formula reads lead time multiplied by average daily usage plus your safety stock. So your lead time is the time it takes to get your items picked, packed, and shipped from your vendors. And your safety stock is what you need to keep for those just in case moments. If the delivery guy doesn't show up, so for all those just in case moments. If you leave me a comment down below, I will be able to send you all these formulas in Excel in a very organized fashion. But for now, let's take a look at an example. So if you want to go back to the first column, which talks about the candles, the average daily demand in units is 50 for this business. They want to keep their safety inventory for 3 days, and the supplier takes 14 days to deliver the product. So following the formula, we are going to get to a reorder point of 850 in units. It means when your inventory gets to 850, that's the time that you need to reorder. Okay, you might think you told me when to order, but how much to order? How do I know that? As you guessed it, there is another formula for that too, and it's called economic order quantity. It's the efficient intersection between your holding cost and your ordering cost. The formula is a little bit complicated, but it means the optimal number of units to order at one time. As I mentioned before, leave me a comment below and I will be able to email you all these formula in a very organized Excel sheet. But for now, for this business, we want to look at 1 month of their economic order quantity. Their ordering costs, which is their shipping cost and all the costs associated with ordering, is $600. The demand for their products is $300, and the holding cost, which might be a storage cost, is $100. If you follow along the formula, you get to economic order quantity of 60. If we want to put these two concepts together, it means when your inventory level gets to 850, it's the time for you to reorder. And every time you want to reorder, you need to order in the batches of 60. There you go, I gave you how many to order and at which point you order. Before I give you a list of action items, I wanted to talk to you about the last concept, that is building forecasts. When we build forecasts with our clients, we reverse engineer everything multiple times to get to a well-thought, lean forecast. We look at the top-down approach versus bottom-up approach. If we want to look at an example, the bottom-up approach means look at the profit that you are going to make in a month or in a given period of time, depends on the nature of your business. And from there, reverse engineer everything to the top to be able to get to your revenue number. Along the way, you need to also put your cost of goods sold number in there. That's why it was really important for you to know that your gross margin percentage. And when you have your cost of goods sold, go back to the slides that I presented you with the formula of COGS, and from there calculate how much inventory you need to have on hand. I know it might sound overwhelming, but it is not. If you follow along all the examples I have given you here, you will be able to grasp the whole idea. And don't worry, we are always here to support your business. Just reach out to us and ask for help. So to recap, I wanted to give you some action items to take your inventory management under control. The first one is track your inventory movement from previous months and understand what that movement looked like. From there, look at your slow-moving inventory and understand what you need to do with them to move them quickly. Second action item is understand your gross margin percentage, and if that percentage is too low, it means all your sales are going away with all the cost of goods. So understand that percentage, that number, and look for ways to improve it. Because if your gross margin is only 10%, it's not a very healthy and sustainable business to have. The next action item on the list is monitor your inventory turnover and aim for a higher return ratio. We talked about the concept. It means how many times you were able to turn your inventory around. If that ratio is not high enough, it means your inventory is not moving quickly. So you need to take control of your purchases and make sure to be able to sell them quicker. Come up with different ideas to move them through. And then build your forecasts. The more stock you have on hand, the more you'll have to spend on storage, and for sure your cash is going to be tied up in your inventory. I know it's exciting to go out and shop at the beginning, but it's gonna be frustrating when you see you have a lot of stock on hand that you can't really move them around. And the last is take advantage of all the apps, platforms, and softwares that are out there to make your life easier. But make sure as a business owner you understand your numbers first, the logic behind all these concepts to be able to fully utilize those softwares and platforms. I want to give you my top 3 apps that I really love when it comes to inventory management. When I looked at these apps, I considered price, their features and analytics, their integrations, and ease of use. And I know it might sound boring, but the number one for me was QuickBooks Plus. It has everything that you need to have as a business owner to take your inventory management under control. I just want to tell you, none of these names and businesses give me any money to promote their name. These are just my favorite that I came across when I was doing the research and when I was working with our clients. The next one on the list is Shopventory. If you haven't heard the name, just Google it And then the last one, which is mostly for users of Shopify, called a stock sync. Okay, what are our next steps? When we work with our clients, they actually shared some of their problems and frustrations and challenges with us. One of them was their business is not growing at the rate they really expected to grow. They mentioned that they run out of cash. Sometimes when their monthly expenses are paid off, they just don't have enough expertise or support to analyze their numbers. And the one that got me by surprise was they make decisions as they go without a clear roadmap or strategy because they are just in it. They are so much into running their business that they cannot really make those strategic decisions. And what I want to tell you is a strong financial foundation significantly increases your odds against business failures. And when we work with our clients, we make sure we take care of their cash flow and really enhance that. We look at their profit margins and look for creative ways to increase that margin percentage. We look at efficient ways to reduce their costs. And at the end, we are a big supporter of aligning business strategies with operations and finance because we understand that always there is a gap between these two functions. When we onboard our clients, we start with setting smart goals. I know everyone talks about goal setting and setting smart goals, but believe me, it works. And from there, we look at their pricing strategies and what is their revenue model. Because sometimes we just forget how we make money. Is it a subscription model? Is it a freemium model? Are we charging the customers by the hours, by the projects? We need to understand that revenue model first. From there, we build their forecasts and their financial projections to understand their short-term and long-term financial performance. We then analyze their cost and look for efficient ways to reduce those as much as we can that doesn't hurt the business. And at the end, we set up key metrics to measure their performance because we need to measure our actual performance against what we expected and celebrate those successes. That's it for today. Don't forget to reach out to us on Instagram. Subscribe to our channel because we are doing our best to put out a lot of informative videos out there for you, and together we build a stronger business.